IFRS 2 share-based payment establishes the accounting principles for transactions in which entities receive goods or services in exchange for shares, share options, or other equity instruments. Share-based payments are commonly used to reward employees, attract talent, and align management interests with shareholder objectives. These arrangements may involve direct issuance of shares, share options, or cash amounts linked to share prices. IFRS 2 requires entities to recognize the economic cost of these transactions within financial statements, even when no cash payment occurs. The standard improves transparency by ensuring that compensation expenses associated with share-based arrangements are reflected appropriately in profit or loss and equity. Proper accounting for share-based payments is essential because these arrangements can significantly affect profitability, equity, and employee incentive structures. A central principle of IFRS 2 is that share-based payment transactions should generally be measured at fair value. The standard emphasizes fair value because it provides a more reliable and relevant representation of the economic value exchanged between the entity and counterparties. For employee transactions, fair value is typically measured based on the value of equity instruments granted rather than the value of services received, because employee services are often difficult to measure directly. Fair value measurement considers factors such as market prices, exercise prices, vesting conditions, expected volatility, dividend expectations, and option life. This approach ensures that financial statements recognize compensation costs systematically over the service period, reflecting the true economic substance of share-based arrangements within international financial reporting environments. IFRS 2 distinguishes between equity-settled share-based payment transactions, cash-settled transactions, and arrangements containing cash alternatives. In equity-settled transactions, entities issue shares or share options to employees or suppliers in exchange for goods or services. The fair value of equity instruments granted is recognized as an expense with a corresponding increase in equity. In cash-settled transactions, entities incur liabilities based on the value of shares or share price movements, such as share appreciation rights. These arrangements require recognition of liabilities rather than equity because settlement occurs through cash payments. Transactions with cash alternatives may provide either the entity or the counterparty with settlement choices, requiring careful analysis to determine whether equity, liability, or compound accounting treatment is appropriate. Measurement principles under IFRS 2 vary depending on the nature of the share-based payment arrangement. Equity-settled transactions are measured at the grant date fair value of equity instruments and are generally not remeasured subsequently. The recognized expense is spread over the vesting period during which employees provide required services. Vesting conditions, such as service periods or performance targets, influence the amount recognized. Cash-settled transactions, however, are measured initially and subsequently at fair value until settlement, with changes in fair value recognized in profit or loss. Transactions involving cash alternatives may require splitting into separate equity and liability components depending on contractual terms. These principles ensure that financial statements accurately reflect both the cost and obligations associated with share-based compensation arrangements. Accounting for share-based payments requires entities to calculate and record compensation expenses systematically over vesting periods. For example, when share options are granted to employees subject to future service conditions, the entity estimates the fair value at grant date and recognizes expenses progressively as employees earn entitlement rights. If employees fail to satisfy vesting conditions, adjustments are made to reverse unearned expenses. In cash-settled arrangements, liabilities are remeasured at each reporting date using updated fair values, creating potential volatility in profit or loss. These calculations often require complex valuation models such as option pricing techniques incorporating assumptions regarding volatility, expected life, and market conditions. Accurate computation ensures faithful representation of employee compensation costs and financial obligations within IFRS-compliant financial statements. Overall, IFRS 2 provides a comprehensive framework for recognizing, measuring, and reporting share-based payment transactions in financial statements. By emphasizing fair value measurement and systematic expense recognition, the standard ensures that entities reflect the true economic cost of equity-based compensation and financing arrangements. The distinction between equity-settled, cash-settled, and hybrid transactions ensures that accounting treatment reflects the substance of obligations and settlement methods appropriately. Share-based payments can significantly influence profitability, employee motivation, capital structure, and investor perceptions, making accurate accounting essential for transparent financial reporting. For DipFRS candidates, understanding IFRS 2 requires both technical knowledge and practical application skills, particularly in fair value estimation, vesting conditions, and financial statement presentation within international business environments.